John, you've been giving us the play-by-play from your guys' strategy this year, which has had some really well-timed flips from bullish to bearish. So what are you looking at right now as we found a big bounce coming into this event, stabilizing on some important technical levels? What has it shown you guys?
Well, the market really was set up in terms of price about as neutral as it could be going into the election. We actually put out a piece on that yesterday, and the markets are basically coiling. We peaked September 2nd. We came back down, had a little bit of a pullback. You could see that right there on the chart. And that little shrinking coil, it indicates the market isn't quite sure what to do. So it stays inside the line, so to speak. And the 50-day moving average is the dashed blue line, the cyan line that you see that it's testing. We're going to probably open up right on top of that based on futures. And that's balance to me. It tells me the market wasn't quite sure what to make of the election, so it just was going to put it in park here and stay safe. And that's kind of what's going on right now. Those upper and lower boundaries are the difference makers. If we get up through that upper boundary, that's when we get a breakout. That's about I think it's 2% higher than where we are right now. It would be a breakout through the top side of that investor indecision area. On the downside, you got about 7% to go.
Okay, so right now, John, is this a if-then scenario where if we move a certain way, then that's the size of the move? Or does it seem like the market, from your interpretation here, is already trending in that way?
It's a very good question. When the market is sideways in price like it is right now, we tend to go to our internals, and we have a couple of tactical models that we use. One is the Asbury 6. I think you may have a graphic on that. And our Asbury 6 is still negative. It's actually been negative since October the 27th. So what does that mean? It means that the 6 different components, 5 of which have nothing to do with price, they're high yield corporate bond spreads and volume and asset flows into the SPDR, SPY. Those have been leaning down since October the 27th. So that means even though the market is sideways right now, it's currently leaning down. If those metrics flip to positive, which on another couple of days of strength like we're seeing so far this morning, that's feasible to happen. That would suggest that we're probably going to challenge the upper end of that boundary, which again is about 2% higher than where we are right now. Something to watch for right now, I think, is watch a couple of other things to watch. First thing is watch the 50-day moving average. That's the minor trend, the way a lot of people see it. If we start to trade up above that 50-day moving average, that suggests to me we're going to get that other 2% rally and come up to the top of that investor indecision area that you're looking at your screen right now. If our models turn to support that, that would suggest that we could very well have a breakout. And if we break out of there to the top side, again, in excess of another 2% higher from here, that would suggest to me about another 350 points on the upside to go that we could see between now and January. This is a seasonally strong time of the year. Nov, Dece, and Jan, I believe, are 3 of the 4 seasonally strongest months of the year. So that's what we're watching right now. The market is right at a price fulcrum. Our models are currently leaning down, but again, through the 50-day moving average, you start seeing volume getting better, you start seeing breadth getting better. That would turn this positive, and again, at least another 2% higher from here.
Okay, so John, this is where I think it's really important, because nowhere in any of your analysis is there anything about polls versus reality, who's running the show in D.C., whether or not they've got Congress in line, all that stuff. What you're looking at here basically subtracts all of that and looks purely at the price action. And right now, your interpretation of that price action is still one that signals concern. But it could change, and then maybe we'll look back and we'll say, oh, well, it changed because of some fundamental reason or some policy shift.
Yes.
But the numbers don't suggest that yet. So the level that you have to get, you still have to have a really big shift in terms of price action for us to kind of snap out of this funk that we've been in for 2 months, right? Because we're not in a downtrend necessarily. We're just kind of in a funk. We're kind of in this range that's drifting to the downside, possibly.
Yeah. Let's call it a safety funk. There's a name for you. Let's call it the safety funk. We're in this kind of contracting coil, and the market does that. I should say investors do that when they're not sure. It could be a big event, like an election, or people waiting for a vaccine. I mean, it could be umpteen different things. But right now, the market is playing it safe. It's kind of gone into the turtle, to use a boxing sort of a metaphor. And again, we have to, and there's a pad there, 2% higher, 5% underneath where we are right now. That's still inside that investor indecision area. We need to get through that either way. And you mentioned a really interesting thing, that we don't look at the election or try to handicap the election, because we can't. Nobody can. Even if I get the election right, we don't know how the market's going to react to it. You could probably remember that during the previous presidential election. First, it looked like Hillary was going to win, and then it was Trump, and the market kind of made a check mark. It went down for a couple of days, and then it was off to the races. So trying to guess how you invest your money in the stock market by guessing an election is multidimensional chess. You're never going to figure that out. We just follow the data. We want to look for asset flows going our way. We want to see volume and market breadth going our way, and we will jump on that. That's the only logical and safe way, to me, is not to try to determine what the market's going to do, but rather follow the money.
John, one thing here in your metrics that still is red, I think is interesting, I want to just come to real quick, is corporate bond spreads, where if you look right now at corporate bonds, it doesn't seem to be anything alarming. It doesn't seem to be like there's fundamental concern or a shock amount of bankruptcies around the corner. It seems like we've moved on from that quite a bit since the spring. How come that hasn't become a positive force for your model yet?
Because we're looking at, this model is tactical for us. So we're looking at each of these 6 different components of the Asbury 6 through a lens of 21 days. 21 business days is 1 month. So that's our way of looking at 6 different conditions all through the same lens. And even though if you look at a chart of corporate bond spreads, high yield corporate bond spreads, it looks really benign. But if you're looking at it through that shorter term lens, those changes, they really become more apparent. So that is a touch elevated based on our metric, but right, but 5 of the 6 are still negative right now. 5 of the 6 of the Asbury 6 are still negative, and I think that's the important takeaway. Those would have to turn back to positive. We'd have to get the S&P 500 back up above the 50-day to suggest to us that we can at least go back up another 2% and test the upper side of that pattern that we were looking at earlier. And if we break through there, now you're looking at a potential for another 350 points higher, and that would take the S&P, that would challenge 4,000. It would actually challenge 4,000, but we're a long way in between here and there. A lot of things have to happen.